Welcome to India's #1 budget headquarters. Decoding key policies, delivering market-shaping insights, and unlocking the potential of India's growth blueprint. Beaming live from the CNBC-TV18 Motilal Oswal Budget Headquarters.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. I mean, it's a grand studio. We're still working out of. We get to work out of here at least for maybe a day, 2 days more, and we're loving it. But this is also, of course, the CNBC-TV18 Motilal Oswal Budget Headquarters. So welcome to all. You know, the budget was last week's story. This week, the story looks like it is going to be tariffs. I'm Prashant. With me, my colleague Surabhi and Nigel. Guys, hi, good morning.
Hi, morning.
Hi, morning. Didn't much feel like a weekend Sunday or whatever it was, because even on that Sunday, there was so much news flow on the tariff front, and we are getting some pretty severe reactions right now across global market, US futures. You know, buckle up.
Well,
It's that Monday.
budget, Trump's tariffs, the RBI policy, and earnings ongoing as well. Guys, we've got our hands full. Prashant, let's get straight to the action.
You know, markets move so fast. I was thinking, what was last week's big story? It was DeepSeek. It's moved.
Yeah,
the
it's
budget
gone.
is gone. Now it's tariffs. Anyway, you know, let's just quickly run through the big talking points, right? So the tariff missile has been fired, and Trump has done it as he has promised he'll do it. You know, these are effective tomorrow. That is Tuesday. So not very much time left. 10% tariffs on imports from China, and 25% tariffs on imports from Mexico and Canada. I mean, these are the basic headline tariff rates. And this is, remember, 10% is not, and 25% is not just it's on top of the existing tariff. So it's whatever plus 10, whatever plus 25. In terms of energy imports from Canada, it is 10%. So basically oil, etc., it's 10%. Canada and Mexico, as expected, have promised retaliatory tariffs. China's response is the important one. I mean, that has been very mild so far. They've not gone all out and said that we're going to do this, we're going to do that. It seems like we're going to go to the World Trade Organization, this is unfair and things like that. They seem to be not wanting to escalate the situation at this point. And that's important to note. The other thing, and I've made this point earlier as well, the motivation, as written in the executive order, seems to be fentanyl and immigration. This is the motivation. There is no sort of, you know, resolution or standard by which, you know, there's no cutoff by when these tariffs will be removed. But the point is, these are, you know, especially fentanyl, etc., these are relatively easy to do. What stops Canada tomorrow from saying, well, we'll do everything we can to stop the fentanyl flow? I'm surprised no one has done it. They're threatening sort of tariffs on the US, etc., but these are not structural issues. It's not, you know, the US trying to correct 30 years of trade deficit, although Trump has promised that as well. But at least for now, what has been mentioned in these orders is, of course, you know, this fentanyl and immigration issue. So I think at the very margin, maybe a little bit of silver lining. What it leads to think, you know, one to think is that maybe this is not permanent. This is a situational thing which may get corrected as the situation is resolved at the border. Now, the market reaction is clear. Dollar is up, is bid 1% to about 110. Mexican peso, the Canadian dollar, those are getting sold off. US stock futures, the S&P E-mini is down about 1.7. NASDAQ futures are down. Oil is slightly higher, but nothing very dramatic. So you got a bit of a global uncertainty, but you also have the budget boost to consumption, which came through on Saturday. And this kind of puts the focus squarely on local-facing stocks, which is consumer stocks, economy-facing stocks, stocks which are cut off from whatever happens elsewhere in the global market. You know, there is a lot of debate whether this 1 lakh crore is going to be big and how much is it worth, etc., etc. But keep in mind, there is 1 lakh crore. It's not one time. It's recurring every year. And second, you know, this is more than just a number. It's also a signal, right? It's a big signal. Last 4-5 years has been big 20-25% growth in capex allocations. Of course, it's moderated over the last 2 years. And for the first time, the government is spending on consumption, putting more hands in the putting more money in the hands of consumers. There is, of course, rate cuts expected on Friday from the Reserve Bank of India. That will add to, I mean, this mood that I'm talking about. Nifty, just to circle in the levels here, Nifty ended lower, but above the 40-hourly exponential moving average at 23,306. We left off at 23,482. The downside level is 23,110. If the 40-hourly exponential is broken, And on the upside, I mean, the high that we saw on Saturday perhaps is the resistance level, which we need to clear. That is 23,632. Similarly for the Nifty Bank, just to quickly wrap up the levels. So we hit the 40-day exponential moving average and the Bollinger Band. These are levels we highlighted on Saturday morning. And then from there, the market sold off, ended slightly lower. And here, you've got downside level at 48,671 and then the high of 49,993, or you can even go with the Saturday's high, which is higher than 49,993, which will act as a bit of a resistance level. This morning, of course, straight up at an index level, GIFT Nifty will give you an indication of how we're likely to start. But, it's going to be very, very stock specific, and, people are going to look for ideas within the consumption basket. I think that's what's to take note of, and we'll tell you where exactly, which areas as we go along over the next 1.5 hours or so. Surbhi.
And look at that. Nifty is just getting into a jinx. So every time it's going to that recent high of the trading range, 23,500 thereabouts. So today's jinx is tariffs. Very quickly, let's get to the reactions playing out across Asia, and they're pretty severe. Remember, the Chinese market, equity market has still not come back. The Lunar New Year holiday continues up until tomorrow. But you're getting a sense of the reactions in Taiwan, in Hong Kong. Look at how Japan is reacting. That's Hang Seng down about 1.5%. Taiwan's down almost 4%. But even some of the larger markets, like I said, Japan's down over 2%. The Australian market's been down about 1.5%, 1.7% thereabouts as well. So the equity reaction is quite severe. The currency reaction is playing out in the offshore yuan. We'll probably have a more fuller reaction come through once the Lunar New Year holiday gets over. But even there, the yuan has touched a record low versus the dollar. We're talking about levels of around 7.376, so almost going up to 7.38 on the yuan dollar. Now, talking about the yen reaction, relatively speaking, the yen hasn't fallen as much as a lot of the other currencies, including the euro. By the way, the euro's tumbled to a one-year low versus the dollar as well. Even the Swiss franc is weak. The reason why the yen, you can see some green over there, that it's working as a bit of a safe haven right now. And that's because the BOJ policy has been to hike rates. So right now, not too bad on the yen compared to the kind of slide that other Asian currencies are seeing. Finally, I just want to mention crypto as well. Considering the mood is risk-off, Bitcoin has fallen about 6.5% in the last couple of hours, and it's trading below the 95,000 handle as well. So that's just overall sense. What did China say? The official response that we have so far, they're taking this to the WTO. On fentanyl itself, the point that Prashant raised, this is about fentanyl, so why don't countries just say that it's okay, we'll stop the supply? Even Mexico's response has been very, very strong and staunch on fentanyl. Mexico is calling out the US, saying you cannot stop the sale of these harmful substances on your streets. On China, the Ministry of Commerce is saying that the tariff seriously violates international trade, and a frank dialogue and cooperation would be, much more warranted. And they're saying fentanyl is America's problem. The Chinese side has already carried out extensive anti-narcotics cooperation with the US and achieved remarkable results. Japan has noted this, again, because it's a large trading economy and a trading partner. I'm taking note of Japan's reaction as well. Japan says that we're deeply concerned about how the tariffs could affect the world economy. We will have to closely look at how Japan would be particularly affected and take necessary steps in response. Similar, statements out of South Korea, because remember, a lot of South Korean companies, giants like Samsung, have, manufacturing capacity in Mexico. So South Korea is watching as well. And we have the Indian Finance Minister's response, which is going to come up on your screen in just a bit. I mean, she was asked by, obviously, journalists over that Sunday that, what happens if India is next. And the Finance Minister is saying that we're not worried, looking at India's position fairly. The US may not benefit with high tariffs in certain sectors. So the world is reacting. This will take some time to play out. Right now, markets are nervous. That's the short point. Just very quickly to top this off, on the flows picture, guess what? Even on that working Saturday, there were FIIs in the market. They were watching the budget and even trading, and they did what they've been doing, which is selling about 1,300 crores in the cash market. So budget may be over. We have other problems to deal with.
Well, and let's state out the top 3 points that I'm looking at. With regard to the FIs, they were virtually absent actually on Saturday because the gross volumes are down by close to 80%. So today the FIs react to budget, which has a consumption boost. Can they taper down on their selling? That's the hope out here. So we'll keep an eye out on that number. Next up, the derivative data suggests the total open interest is much higher than what we see on averages at the start of a series. In fact, if you compare February with January, on the Nifty, it's nearly 50% higher. So this market is heavy as of now. And finally, the next cue we're looking at is monetary policy easing, which is during the week. And the hope is that the RBI goes ahead and injects liquidity. They've done some bit in the recent past with regard to those OMOs. So liquidity, putting in some liquidity, that's something that we're looking at. How the FI is placed on index futures? Well, The short positions are at around 88%. This is the highest we have seen in the last 15 months. And getting into a budget, we have never ever seen the FIs with 88% of their positions on the short side. Those are the couple of data points with regard to the index futures. Moving to the absolute numbers, the FIs, yes, they're net short, the clients are net long. Both of them are the opposite ends of the spectrum. But a quick check on the options data. Two strikes I'm looking at. 23,500 call on the upside, the 23,200 put on the downside. Both of them were active. And if you're looking at levels, well, you have a couple of, goalposts that you're looking at. So on the downside, the 20 DMA comes in at around 23,270. So that's a mark you should be looking at. But going by the options data, you don't want the 23,150 odd mark to break. That's the downside level. On the upside, the swing high was closer to around 23,650. So that becomes the important resistance mark. The Nifty Bank, well, close to around 1% away from here, around 550, 600 points away from here. You have the 20 DMA. You don't want that level to break out. Stocks that I'm looking at, some of these chemical-related names, PI Industries, UPL, as well as Jubilant Ingrevia. And the reason that I'm looking at them is because of these tariffs that have been imposed. A high percentage of their molecules go into the US market. There was the fear that Chinese will produce more. That fear gets a little bit of a pushback. So in that sense, valuations as well are relatively attractive in comparison to their 5-year averages. Put all this together, Equaris has come out of the note and they're saying these are the stocks that could be in for a bit of a short squeeze. We'll keep an eye out on that. And finally, guys, is looking at a lot of those budget numbers, the STT collections are expected to go up by close to around 40%. That would mean that the government is factoring that the equity markets could remain buoyant. Because from around 55,000 crores, they're talking about 77,000 crores.
Yeah.
So a glimmer of hope out there. Even Delhi believes that maybe the equity markets should remain buoyant, and that's why they're factoring in these collections.
Will they do anything to help it, right?
Important, and that's the hope.
Absolutely.
Well, they did to an extent, but now I think we have to see if the markets are not happy with all of it, I guess.
Absolutely. Let's get Samir back on, right? Samir Arora, founder and fund manager at Helios. Samir, good to have you with us here. Thank you for waiting. Appreciate it very much. So what is top of mind to you, tariffs or the consumption boost here, and what will drive markets from here?
So on a relative basis, it will be the budget, in the sense that actually the budget was good and we'll talk about it. But if the overall markets are down a lot, then India may outperform because A, it's not directly affected, and B, don't worry about markets like Taiwan because they have been closed for a week. So if you just look at how TSMC ADR was trading during this period because of NVIDIA and others, and then the TSMC local fall. So don't get totally carried away. A little bit you're allowed to get carried away. But the point is that the budget was good and this tariff situation is bad. But the tariff situation doesn't look as if it's going to be there for 6 months and 9 months. I mean, these guys have to be able to demonstrate a little bit about the demands of Mr. Trump on fentanyl and all. And I read that Canada is saying, see, we bought these 4 helicopters and we bought some guns and whatever else they can demonstrate. At least this doesn't look like this itself is a trade war forever, because the ask is not related to trade as of now. It is related to reducing immigrants and drugs, which actually in theory are easier to show by saying we have, more forces, more tracking, more inspections, whatever.
So it's not permanent, and that's exactly the point that I was making earlier as well, that it's easier to do. I'm surprised why they've not done it. Put out a statement, strong statement saying that we're going to do everything, all of this. I don't know what's the problem.
And I think it's because they are upset in general with each other. But actually, it's not started yet. It is supposed to start tomorrow.
Yeah.
And I think Trump has just tweeted or whatever has commented that he's meeting them or talking to both these guys today. And China, realizing that this is just a bit of drama, has not said anything back.
Yeah.
So it is bad, of course, but it's not like this is it and now, therefore, this is like 1930 when there were trade wars and markets fell. But right now, part will overshadow the fact that it was a good budget.
But the Mexican president's statement was quite hard-hitting and frank and fair. I mean, like I said, Mexico has been calling out U.S. right back, saying that you're not able to police your streets and what's going on there. We are doing enough. And she went on to say that cooperation is fine, but essentially bullying is not. And I think that's why these countries haven't immediately buckled under pressure.
Yeah, exactly. That's what I'm saying.
Yeah, it's about the tone tonality.
Ego now. It's a bit of ego. It's a bit of ego, but obviously Mexico is at fault. There is a doubt on that. But of course, U.S. also has to control. But obviously, I mean, you don't believe all these guys are coming in and drugs are coming in. because there is demand. Obviously, the other side has not been. Otherwise, how can you have these cartels and people running those cities and whatever movies you've seen?
So,
So it is both ways, but I agree with you that
Yeah.
this, if they want, can be done. I think plus, let's see.
absolutely. Yeah. So let's see if some of those ego issues can be resolved in these, parlays that will happen. Now I'm sure the diplomatic channels are, working in overdrive. And the best part is that China hasn't taken a very strong
Yeah,
stance,
that's
an
right.
anti-stance. They're saying we'll take it to the WTO.
WTO
WTO disputes run in years. So we all know how that goes. But Samir, having said that, there is the immediate reaction to play out. Sort of how do you look at that? Because for us, now I was trying to find silver linings. The only silver lining I could see for India was that finally the US market is buckling. Maybe for a
That's
short.
also one positive.
Yeah, so your thoughts on that?
No, so that is that is one of the points, but I thought we were talking budget first. But that is, of course, important because this obvious thing that you will sell emerging markets and go, of course, they will say even more improves because currency has strengthened. US and Indian currency right now looks like 40 basis points down, about 86, 90 or something. So these things are now, you can spin it both ways. But in general, beyond a point that the fact that you can't put everything in one basket, particularly for global investors, long-term investors, and see there are fund managers who cannot put it in US, they themselves. They will not go to their investor and say, please take my money and put it in US. So the emerging market fund, the Asian fund, the Asian emerging market funds, global fund, and then there is this other side of people saying US has gone up so far, too much, exceptionalism, US will not last. Ruchir Sharma keeps saying that there'll be some followers of that thesis also. So beyond a point, that trade is not so important that, people will take money from India and go to US. I think FI selling is not beyond a point a big negative. It is that whether India is doing well or not. And then there is some correction of excesses and stuff like that, which clearly seems to have been done.
All right. Hi, Samir. Good to see you. And Samir, since you spoke about FI selling, do you think it's getting to the fag end? That was the hope at the end of 2024. And bam, 2025, they're selling even more. Do you think,
So actually, if you look at it, look at it, September was a massively positive month for India, some 7-8 billion positive. And October was negative, some 10 billion. Then November was sort of zero-ish, 1-2 billion minus, and December was plus.
Yes.
And again, Jan is big negative. So now we have to make some story. We can't say random. So the story which has to be consistent is that in October, they were thinking that US positioning and, Trump winning and dollar strengthening. And then December, they were positive again. And Jan, again, negative. One reason has to be India related. That Indian results came out very bad. Because if you see, Taiwan was not negative. It's an emerging markets. It is an anti-US. I think Korea was negative, but not a lot. Basically, the entire emerging market negative in January. I think February just started. So must be January. Was I think some $7 billion negative, and all of it was India. So now if India improves or it corrects, or generally some stable thing is found, this continuous selling does not have to happen. Then it'll turn to buying also. So I'm saying the default in general is not that foreigners sell. The default is they buy and sell, but in the end, mostly means last 25 years, even if you see last year, there was sort of net zero. They bought primary. Now, why did they buy primary? Because the primary stocks are different. They are not the companies, whatever, this consumer tech or fintech or whatever tech. And so out of your $800-900 billion to the new age kind of stuff. So what is so unreasonable? You would have said flows have been flat for last year.
Right. Got it. Samir, so for viewers watching, right, there is a boost to capex infra type of names. There is one view which says that this could say, well, this was the inflection point, not because it is 1 lakh crore and is going to do, but basically it was a shift in focus. the style factor will change from what you should look and do here. So I just...
It is one of the best budgets that we've seen in many, many years, and I tweeted it's a dream budget.
Yeah.
So first thing that you normally want money with, the public rather than with government. It's than money with the government. Number two, you have not taken money from one group and given it to the other, which would you are deciding. Here they are saying you just give us less money. It's not said that, oh, you've cut a tax rate across the board, therefore the rich will get much more. It has come to the correct audience in that sense. Other than that, on I see in the reports that I get and on Twitter and all, oh, only 3% people are affected, only 4% are affected. So if the government announced that there'll be a new road being made between, I don't know, say Faridabad and Meerut, only 2% of Indians will use it. The South guy will say, how do I care you made a road there? Everything that you do, only 2-3% people, 5% people. The reality is that there is no capacity to invest more in a road because the big roads are being made. And if anybody believes that a road that is not doing well, made well, is because of money, or is it because of management, or is it because of corruption, or is it... So learn from the US. I'm telling you, Donald Trump is going to be a massive positive influence everywhere in the world, including in India. Yeah. Because you will realize that tax cuts and efficient government and cutting expenditure and all that. And secondly is, for whatever reason, which is now history, this year money could not be spent on infra and could not be spent maybe a little bit on defense. So now next year, what is the point of saying I will give 25% more budget to that section? It is better to say I will implement what has been done. But the reality at the end of the day is that money with the public is the best way. And in this case also, since there is a temporary or cyclical or short-term slowdown, it is better to deal with a temporary or cyclical or short-term up by saying, hey, take money. Or
no, but Sameer, this
instead of saying, I will make an infra which will take 5 years to implement.
And this is
which
now
also is needed, but separate.
The point is, this 1 lakh is not one time, it's recurring every year.
Yeah, exactly.
Hopefully.
So you get 4-5 times than the spending.
Yeah.
Because you can buy a car, you can buy
absolutely. So briefly, Sameer, if you can, but the point is that you said they're not taking money away. Actually, I'm not sure if that is true because capex growth, right, capital allocation is expected to, be 10%. And if you look at tax assumption growth, right, income tax collection growth is assumed at 14%. If you add back that 1 lakh crore, it's 22-23%. So generally, it's very possible that expenditure will slip. And where will it slip? Mostly in capex again. So the question is, will we see some derating in infra type of names? And switching is always difficult to try and it's because capex, infra, etc. has worked for so many years. But
should one... Of course it derate. Yeah. That is why I'm smiling. I have been betting against that because those companies don't deserve 40 and 50 multiples because nowhere in the world, consumer also don't deserve, but consumer have had it for 50 years, so what to do? Or 30 years, higher multiples in India and in other countries also, higher in consumer than in infra and road building and water treatment. So that is just the reality. And therefore, I read some report, which is a good report, that you can move a little bit from value to growth. There has been too big a difference on winning an order, you make a stock go up. So that will definitely happen. The derating will happen because the money is ultimately fixed. Even FIIs will simultaneously try to churn even if there is net positive, if there is. Absolutely.
So Sameer, let me ask you this because, in India, we always swing from one extreme to the other, right? It's always extreme pessimism, then extreme optimism. Let me ask you this. Now, as the street starts chasing these consumer stocks, what is the PE you are willing to give and pay for to, say, a consumer staples company? And then let's talk about one of these internet consumer companies. The question is, how long will you buy them? At what price?
Consumer staple company, so we will not buy only.
Oh, okay.
Because consumer staple is ultimately, you may say they have more money, less money, but most of these guys could afford those consumer staples that they are supposed to buy more of. And it's still a very small percent of the audience that buys consumer staples. But consumer durables they could buy, and cars and all they could buy. But we don't like the sectors, but they could buy. But in other sectors, which is these food and all, the growth rate is too high. So if you just change the growth rate by one more year, or you change the fact that the margin is a little bit better because more people are doing, and then suddenly these valuations can change a lot. But again, remember, we only have 12-14% in all of them together. And we consider that as being like aggressive, and you also, and world considers that we are aggressive. So within that constraint, I mean, that context, it is still highly bullish. Actually, the number one most bullish, may I add, was actually Zomato, because not one person in the country has understood except me that what was that one line that was said. So Mrs. Sitaraman in the interview said that these gig workers, and I panicked. I said, shit, now they're going to say something about, treating them as employees or whatever. She said that all these guys can enroll in some system, whatever she said.
Yes,
we will give
registry.
their insurance. So please remember, 2 hours before or 5 days before or 1 month ago, we were saying, these workers are exploited. These companies are competing with Kiranas. These companies are creating this distress and that distress. And now you are saying the employees that these guys have hired, or not even employees, whatever you call them.
But Sameer, many of those,
recognized.
well, let's see. I mean, many of those things and those actions can always happen outside the budget. We'll have to wait and watch this space. But we've understood your point.
No.
Yeah.
That way, if I say if anything can happen, tomorrow there can be war between India and Pakistan, so we should sell. Tomorrow China can do the if. Don't say anything with if.
Okay,
Today is what has been done.
Sameer,
If you can add anything in life. So may I just tell you a joke before I go?
Yeah.
So one guy asked another guy, how are you feeling? He said, I'm good. He said, what if a truck hits you? Then he said, I will not be good. So if you can add anything in life to be circumspect.
Sameer, 30 seconds, where will that money go? Where will people send their money, you think? Cars, flying, foreign vacations, this 1 lakh crore, where will it go, you think?
Oh, 1 lakh crore. No, I think some of it will go into savings, say 20%. But before that, there was nothing negative on financials, and in fact, maybe positive, independent of this US issues now, that you would have had an interest rate cut or liquidity. There was nothing done wrong to IT guys, but those stocks fell to 2%. So I'm saying generally, the good thing about this budget was that nobody was harmed in the making of this budget. Like we say in a movie, that no animal was harmed in the making of this film. Nobody was harmed and some were benefited. So that's okay.
Well, Sameer, we are going to remember this because it's not very often.
1 minute. He's not answered the question. Where will this money go, Sameer?
So I'm saying,
three sectors.
No, it could go. See, it's a little bit of an upper end benefit. So it has to go into things which are not so very basic also. Because you will say that the guys but up to 10 lakh or anyway, or 8 lakh or anyway not paying or paying very little. So the benefit is a little bit upper middle, whatever you want to call it. So it has to be travel. It has to be savings. It has to be these car consumer durable types. As I said, we are not buying those, but they could. But we are not going to, for this basis, buy some soap and shampoo maker as if they were, waiting for this.
All right, fair enough. Sameer, thank you very much for joining us. Great speaking with you, as always. And, come back again, because this tariff thing will continue and there'll be lots of headlines.
Just one point, guys, I wanted to make with regard to this capex. We're all talking about the capex spend. It's been increased only by 10%, right? But if you look at the inclusive number, that's including the state as well.
The PSU capex, yes.
CLSA has pointed this out in their note that actually for this year, if you take the inclusive number, then it's a 19% growth in comparison to last year. Last year it was around 15%.
No, I know, as I said, but the point is, it's like shifting the goalpost. I mean, still now we are saying, look at the state. Now you're saying, look at 8%. I understand that I like to like, and I think Shireen asked that question to the secretaries as well, and they said, well, there's no shift away from focus. But the point is, if you look at the number they've been talking about for the last many years, there is a clear sense, and I think, they've assumed, as I said, some 14% income tax growth.
Yeah.
And you said they're assuming very buoyant markets.
Indeed.
I mean, it doesn't happen like that. Markets wish and government wishes and the market
income
obliges.
tax number, I think a lot of people have
so
put out
there will be
that
some slip as far as
14%
capex is concerned. And I think that's the reason why we'll need to wait and watch. We'll take a quick commercial break here. We'll come back and we'll just quickly tell you what the lineup is as well over the next 2.5 hours or so. Gautam Duggad is with us of Motilal Oswal. He's coming up in just a bit. We'll talk about budget impact, various sectors, etc. 9 o'clock, you'll hear from Neelkan Mishra of Axis Bank. And of course, that's the top voice, macros plus markets. 9:15, S. Narain of ICICI Pru AMC joins in to decode the budget. At 9:30, we'll have the management of Indian Hotels. Sameer just said travel is one area where people will spend. Then we'll have Rhythm Desai come on of Morgan Stanley. So that's a top equity strategist who comes in. And of course, before the budget, he put that note out saying that keep the faith. This is just one of those phases that we're going through. At 10:15, it's the economy. Lata will be discussing the big numbers and putting the focus there. So we'll have B. Prasanna of ICICI Bank and Kaushik Das of Deutsche Bank. Come on.
Welcome back. Still deep cuts across most of the Asian markets. By the way, the Chinese PMI numbers also came in. The Kaishan manufacturing PMI slightly lower than estimates, just around the 50 handle. Markets are still down 2.5%. Japan, Hong Kong's trying to cut its losses to an extent. The implied open is telling us that we'll start obviously around 200 points lower, and then let's see what happens from there. There are, of course, lots of stocks to track as well on the back of budget-related news flow and other company developments, and of course, auto sales that have been trickling in. So let's straight away get to our team. We have actually Sudarshan joining in first up. We had some numbers coming from the two-wheeler guys, I think, Sudarshan, on Sunday. Tell us more.
So I have two companies that have reported numbers post-budget announcements, and one is Eicher Motors, which continues to report a strong set of numbers. For the month of January, it has reported numbers more than 91,000 units, and it was much above our estimate, and that was above 4%. So total sales have come at 91,132 units versus estimates of 87,005 units, and all the segments have seen a double-digit growth. Bike up to 350cc capacity has seen a growth of 17%, and more than 350cc capacity has seen a growth of 44%, and exports have seen a growth of 79%. Coming to Eicher Motors, total sales were in line with estimates of 4.42 lakh units, and it's up 2% year-on-year, and that's supported by exports. Domestic sales, though, remain under pressure. It was down 2% at 4.13 lakhs unit. Now, growth was supported by two major markets. The first one is Bangladesh, and second is Colombia. Also, the budget announcements related to rural sentiment boost will be supporting the entry-level segment, and that will be positive for Hero MotoCorp.
Okay, all right. Thanks a lot for that, Sudarshan. Well, let's hop across to Vivek. He's here to tell us about this airport tariff paper that's come out. Vivek, tell us more.
Good morning. Well, that's right. You know, what we need to keep in mind is that companies like GMR Airports that are airport operators, they get a fixed return on the kind of capex that they go ahead and put for generation as well as development of airport facilities and airport infrastructure. Now, this particular tariff is determined for a 5-year period. So what's in the latest update is that the consultation paper has been published for the tariff period between 2024 to 2029. Now, this particular tariff is for the airport of Indira Gandhi International Airport, where the airport operator is GMR Airports. What is the new tariff that has been advocated in this particular consultation paper? It is at 370 rupees per passenger versus the existing rate of close to 143 per passenger. Almost 2.5 times increase is what is being advocated. What is the matter under consideration? A higher regulated base because of the new capex that was undertaken at Delhi, and also the Supreme Court judgment as far as aeronautical taxes are concerned. What is the way forward? Stakeholder comments are invited till 31st March 2025, and the company has said that they expect the tariff order to come through in the next 2 to 3 months. Jeffries has reacted to this particular development. They've cut the target price to 92 rupees from 100 rupees. What they're saying is that the aero tariff proposed at 370 rupees a passenger is actually lower than their estimate of close to 500 rupees per passenger for 2024 to 2025. On the back of that, they believe while it is slightly negative versus estimates, it believes a significant uncertainty and overhang around the quantum, given the fact that there was quite a lot of delay in the determination of tariff. They've cut they estimate FY24 to FY27 EBITDA CAGR of 25% now versus the 30% that they were earlier pegging in. But overall, a positive development and an important development as far as GMR Airports is concerned.
All right, Vivek, thank you very much for that. So keep an eye on that one. Commodities in focus. I think Canadian imports into energy imports into US now tariffed 10% more. Manisha, what's happening? What's top of mind?
Oh, well, yeah, absolutely. Prashant, I'll quickly take you through commodities. Crude, for one, has snapped 2 weeks of losses. We are looking at 1.5% of gain in crude oil prices. After these tariffs coming in, well, there is crude oil disruption concerns as energy products from Canada are tariffed at 10% duty, not 25%. But Mexican energy is to be charged at 25%. And US does import a huge quantity from both of these countries. So we have seen that premium come back in case of crude oil prices. In gold, we are trading very close to all-time highs after this uncertainty and inflation concerns. For base metal prices, well, it's a big arbitrage that the global markets are trading with. You have seen the base metal prices decline on London Metal Exchange and in China, but the U.S. Metal prices are trading at a premium right now. Well, remember that U.S. imports 36% of its copper requirement, 82% of its refined demand in aluminum, and 67% of its zinc requirement. So you are going to be looking at these metals trading very, very volatile until we see this whole tariff war settle down.
All
right, Manisha, thanks a lot for that. Well, time to slip into a short break. Up next, as promised, Gautam Dugar of Motilal Oswal is waiting for us. He'll give us his first take about the budget and how is he seeing markets pan out from here on.
Welcome back. We're continuing our coverage on what this budget, of course, means for stocks and the market as a whole. And now we have with us Gautam Dugar, Head of Research at Motilal Oswal Financial Services. Gautam, good morning. Great to have you on. So you've had a Sunday to now go over the details and, get down to the stock level reaction. And we were just looking at some of the, the top picks in the portfolio. Obviously, lots of consumer names out there. We'll put that up in just a minute. There's Trent, there's Titan, which has been one of your long-standing favorites. There is M&M, Maruti. So just run us through the thought process. What is the allocation shift in favor of consumers?
Good morning, Subhi. Thanks for having me. So yes, on balance, I think it was a pretty decent budget print. Numbers are quite believable as they've been for the last 4-5 years for this government's budgets. Second, without impacting the fiscal consolidation territory, they've shifted the scales away from consumption, capex towards consumption. If you look at the percentage numbers between FY21 to 24, the capex compounding was 31% in terms of allocation, but the next 2 years now is about 9%. As far as the actionable portfolio-related changes are concerned, I think there is going to be an imminent shift from consumption to capex. Reverse capex consumption. Yeah. Now, what has happened is if you look at the portfolios of the top domestic funds, which are public, you would notice that most of the top 20-25 mutual funds in India, as of their last disclosed portfolio, are overweight on industrials. And almost 80% of the domestic institutions are underweight on consumption. So there is definitely going to be some realignment which will happen. Of course, people will not immediately move from underweight to overweight, but more closer towards equal weight and slight reduction or trimming in the capex portfolio. Second, generally what market does is the multiples change first and numbers follow later. So capex multiples have already corrected. If you look at the last 3 months of the capex stocks behavior, even big names are down 30-40% now. So large part of multiple contraction is already underway. Some more can happen. And then numbers actually will continue to remain strong. This quarter has been very strong for capital good companies in terms of earnings growth. Maybe it will continue for a quarter or two. But what market will start factoring in is the reduction in the order book growth, say in the second half onwards for FY26. And that's why you will see multiple contraction happening ahead of that. And I think the exact reverse can happen in consumption names. The consumer companies' numbers have been absolutely weak. This quarter, there is actually a decline in earnings for consumer companies. Very rarely you see consumer companies post a cumulative earnings decline. So that is happening right now in third quarter. I think the earnings can continue to remain weak for a quarter or two. But the multiples have been derated over the last 3-4 years for staple names, basically, not for discretionary names. Now that reversal can happen, and numbers, again, as I said, for capex can follow after 2 quarters in terms of moderation. For consumption, it can accelerate after 2-3 quarters. But typically in consumer staple companies, you see growth averaging somewhere close to 10-15%. Volume growth is a more important number.
So
as far as we are concerned,
Gautam, just to complete that point, this is exactly what I was trying to ask Samir Arora, who was with us a couple of minutes back, that as this shift plays out from capex back to consumer stocks, what sort of a multiple re-rating and a multiple expansion would you expect from where these stocks are? I mean, let's say, if you're talking staples from, the mid-50s or so, can they go back to 75 plus 80 times, forward earnings? Where would you expect the maximum delta in multiple expansion? Durables, jewelry stocks, staples, travel and tourism, hotel stocks, where will it come?
So, Surbhi, it's very difficult to pinpoint a number specifically because consumption, again, is a very, very diverse ocean, right? There definitely is going to be some re-rating in staple companies because that is where the maximum de-rating has happened in the last 4 years. If you look back at the multiple of Hindustan Unilever, I'm just taking that as a representative because it's a bellwether consumer stock for staples. The multiple used to hover around 70 times in 2020. Now it is somewhere close to 48, 50 times.
Exactly.
So can there be some re-rating there? Definitely. But the number delta, and I think the earnings delta is far more important than just the valuation multiple delta. And I think that delta will play out more in non-staple stock. So see, look, the total bounty is 1 lakh crore. Some of that will definitely get saved. There are various estimates, 20, 30%. And some of it will definitely be used to deleverage the household income balance sheets because that's where we've seen some strain in the last 2 years. So then if you work out the number, you roughly reach a number of 50, 60,000 crores, which is left for consumption. Of course, it will have some multiplier effect and all, but that will take longer time to play out. In the interim, you will see discretionaries benefiting much faster, in a much bigger quantum than just pure staples, because the category of the taxpayers which is getting this benefit are not bottom of the pyramid, absolute bottom of the pyramid, they're middle class, right? Where the staples had not gone down completely in terms of consumption. The staples decline that you've seen over the last 3-4 years was manifested more in very low income households. So we think retail, some bit of auto, consumer durables, jewelry, hotels, those are the companies where you might see probably slightly better, performance. And that's why in our model portfolio, we're still underweight on staples. Maybe we will also realign a little bit of a weight within the consumption pack. But at the moment, we are heavily overweight on discretionary or staples.
Yeah, got it. It's pretty much in sync with what Samir also just told us, that the discretionary consumption, that's where the bigger boost will come.
And Trent has provided a good entry opportunity, right, Gautam, as per y'all?
Yeah, I mean, see, Trent has had a very fabulous last 3-4 years in terms of both earnings and stock price performance. I remember in April 2022, when we upgraded the stock at 1,200 rupees, the valuations were not cheap. And since then, they've become even more expensive. As you rightly said, the stock has corrected somewhere close to 25-30%, which is, by the way, broadly in line with what most of the other discretionary stocks have also corrected recently. But the earnings growth in Trent is at least 2x to 3x of rest of the peers in the same segment, both on top line and bottom line. And top line delta is far, far bigger because in bottom line, you can still manage margin, play around with the cost. But top line being 30-40% versus 15% or 10% of the rest of the companies in the same category essentially means that your execution on the ground is far, far superior to your contemporaries. So I think, therefore, they get that multiple that they're getting right now. And we think the growth can continue for a couple of more years because all their subsegments are firing very well.
Gautam, also wanted to ask you about a couple of other names. One stock that was notably strong, which had corrected, getting to the budget, was Angel One. That stock, I think, on budget day was up close to around 5% or thereabouts. From the capital marketplace, that's your top bet?
Yes, along with a few other names, Nigel, as you said, we right now we have a very vast coverage on capital market. We cover every single listed capital market play. So our bets are on BSE, Angel, and HDFC AMC. Basically, we are trying to play the whole spectrum of the capital market story out there through exchange, through asset management company, as well as a broker. Now, to particular point, in Angel, stock is down somewhere about 35% from the top of last year's January 2024 price. Multiples have also corrected. There have been a lot of changes in regulations that we are all aware of. There is roughly a 20% impact on their earnings, but the stock has corrected 35-40%. And therefore, the multiples as we speak now are somewhere closer to 15-16 times with ROEs upwards of 25%. It's a very pure play, digital market play. So we continue to like the name and we still have it in our model portfolio.
Right, no, absolutely. Gautam, if infra has to derate and consumption has to re-rate, right? First of all, do you think it will happen? It's going to be painful, isn't it, for portfolios? Because point is, you know, as they say, if you have to panic and sell, you must sell early. Stocks are already down. Now everyone is waiting for, chalo, let's hold, we'll see, it'll come back. And now this government is saying focus on consumption, not on infra in terms of spending. So it'll be a tricky and painful for portfolios, for money managers, isn't it?
Yeah, absolutely. It's not going to be easy. You don't just wake up one day and change 20% of your portfolio. Because for all said and done, consumption is somewhere close to 15% of the portfolios, and industrial somewhere about 5 to 6%. I'm talking about a very broad top-down level. Of course, individual portfolios are very different weights. So you don't just wake up in the morning and change 20% of your portfolio. It's going to take some time. And it's, of course, going to be painful because everyone else is trying to do the same thing. So, right, if you were lucky and you would realign your portfolio a few months back, that's a very different thing. But what has happened, Prashant, also is a lot of time the portfolio changes also involve a non-tangible element. Like, you know, you play on the psychology, because when most of your peers are going to do that, and you're also thinking that has the government changed this view just for 1 year, or is this going to continue for next 2-3 years again? If that were the case, then of course the capex multiples will take a long time to re-rate back to the levels where they were trading at till about 6 months back. So therefore, it's a call you have to make, that do you sell into the bonds, which will definitely happen at some point of time. Because if you look at the data, the December month capex data of government is very strong. If that continues for Jan, Feb, March, and if there is some rebound in stocks, possible that a lot of realignment again can happen into that strength. But that's like speaking in terms of too short term of behavior. Broader point is, if the government is changing its focus, I'm not saying that they're defocusing on capex, but the 30% growth that we have seen for FY21 to 24 is now wavering around to 10-12%. And of course, there is an element of execution as well.
Sure.
You cannot just look at more and more because the underlying state governments, the rest of the government apparatus has to also be able to spend and execute on that.
Absolutely. And they're waiting for the private sector to do it as well. Sorry, Gautam, we're very short on time. 10 seconds. Top 3 consumer discretionary stocks that you would have a buy on. Top 3 consumer discretionary stocks. Just the names.
So we've just spoken about it. Actually, it's Trent, Indian Hotel,
Indian
and
Hotels.
Titan. Yeah.
And sorry, the third one?
Titan. So all three are part of our model portfolio, just from a point of view of disclosures.
All right. Gautam, thank you very much for joining us. Great speaking with you. It'll be interesting to track this and how it plays out over the next many weeks, and we'll come back to you. We take a break. We're back, and we'll get you some trading ideas as well. So our experts will be with us on the other side. We'll have Mitesh Thakkar join us, and we'll have Sudarshan Sukhani as well. So that's coming up in just 2 minutes.
Welcome back and hope you're having a good morning. Well, as promised, let's get our technical experts on the show. Good morning, Mitesh, as well as Sudarshan, and thanks a lot for joining in. Mitesh, you go first. We had this range bound sort of day on budget day, and we ended more or less flattish after moving quite a lot intraday. Your take on the Nifty from here on? Where does support lie? Where's the resistance? And what would your trade be?
Good morning, Alan. So first thing on the upside, I'll start with that because the high which you made on Saturday was 23,630. And that's an area where a couple of, modified moving averages are placed, and they've turned flat, indicating one, lack of volatility. Two, I think, that the declining trend might be over. So despite the fact that we'll open gap down today, I expect more of a sideways kind of a consolidation. The first level to watch out on the downside is 23,350. If that holds, and we might open about around those levels. So if 23,350 holds, then we'll do a range of 23,350 to about 23,630. In case we start breaking below that, then I think we might have a maximum downside of 23,000 to about 22,800, which will be a retest of the earlier. So doesn't look like a market which will go into a bigger fall. But yeah, I think with the global events and the way GIFT Nifty is indicating, we might see a gap down. But in case, as I said, I think, the first thing is that if we hold or if we don't show strength to break below 23,350, then I think it's a market which I would want to buy into.
All right. Okay. Got that. Mitesh and Sudarshan, good morning. Thanks very much for being here. Sudarshan, what would you do? I mean, budget day morning, you were saying stay out of the way, right? And I came to you by saying, well, on budget days, even if you're right, you can be wrong, and vice versa. And it was a big move up and down, really inconclusive. This morning, it's more conclusive, and it's on the way down. What levels and what's the trade?
Yeah, good morning. And you're quite right. And that was the trade, not to do anything and just enjoy the budget. See, what has happened is that we've had one leg of the up move from 22,800 to, let's say, 23,600. That's 800 points. That's a decent up move. Now, the chances are that the markets will have a correction of some kind of this up move. That correction will have two different aspects. First is a normal correction. And the second is, we made a low of 22,800. Was this a bear market rally, or is this a real thing that's beginning? That we will find out when the market tries to go down near 22,800, the final low. If that low holds, then we have a big message, and that message will be that the bull market has resumed its journey. This process will take many days. It's not going to happen in 1 hour. But the view is for today, I don't think there's a trade in the Nifty. We really want to find out what are the lows at which the Nifty finds support. I can't give you a number. The market will decide that. Till then, it's best to focus on stocks and step aside.
So you're stepping aside from the index, Sudarshan, but what about individual stocks?
Well, it's a mix of sell and buys. SBI Life is an intraday short, stop above 1485. Angel One is an intraday short, stop above 2550. Crompton is a buy. That is a buy on dips. It's gone through a decent correction. Buy with a stop under 360. And M&M Finance is making a very attractive pattern on the upside. So it's a positional buy. Don't expect some drama in a day or two, but it's worth buying and holding on to. Stop under 255.
Got it. Sudarshan, thanks very much for that. Mitesh, let's come to you. Good morning. Your stock picks for the day.
Good morning, Subi. So I have a mix of buys and sell calls. On the buying side is Eicher Motors, made a fresh high, all-time high, and the chart pattern looks very strong. So in case you get a morning dip around 53.60, buy here with a stop at 52.90. 5500 is my first target, and a buy on Indigo with a stop at 44.25 for targets of 46.20. And on the selling side is HCL Tech with a stop at 17.11 for targets of 16.60, 16.55. And Gujarat Gas, that's a sell with a stop at 4.67 for targets of 4.41.
All right. Come back to you, gentlemen, soon with more questions. Thank you for joining us at this point. There's, 3 minutes to go for the pre-open session to kick off. We're back in just a bit. Okay, welcome back. I think we got the first pre-open rates, etc., coming through, which we'll let them settle and come back and look at the prices in a bit. But let me welcome in Neelkant Mishra, Chief Economist at Axis Bank and Head of Global Research at Axis Capital, who's now with us. Neelkant, of course, is the number one voice that people sort of look to after the budget, and he's with us. So we're very pleased. Neelkant, good morning. Great to have you with us here. Thank you very much. There's so much to discuss. Let's keep it, sharp and pointed. First up, is the interpretation that the government is moving away from infra and focusing on consumption correct? Because it's got implications for markets as such. Go on. You're on mute, Neelkant. You'll have to unmute yourself, please.
Yes, we can hear you.
We can.
Okay, sorry about that. So I disagree with that because the limitations on how much the government can do on capex was clear even last year. Remember that out of the 11.1 lakh crores, 9 lakh crores was stuff that the government could control. There was 2.1 lakh crores that they had no control over. So we are hitting the limits on what the government can directly do in terms of capex, and therefore the guidance from the government was that we will maintain capex as a percentage of GDP year onwards. That the scope for us to do more is now gone. So now they're experimenting with, for example, this 1 lakh crore that they've decided to spend on urban infrastructure, but through a competition mode. So the states need to compete for it. They have to find such avenues so that capex continues, but there is very little more they can do at the central level. So I don't think this is a stepping away from capex.
Absolutely. Neelkant, in fact, if you could just elaborate on that point, another sort of, statement that's been doing the rounds, or calculation or thought process that's doing the rounds, is that if you add up capex from the states and the capex that will be done via PSUs, and maybe we're still talking about 20% growth, almost 19 to 20% growth, and not the 10%, which is direct capex, which is in line with nominal GDP. So how would you read into this, the form and format that capex will take from here on?
No, I think those are also very interesting points, but we need to take a step back here and figure out that if gross fixed capital formation as a percentage of GDP in India is 32%, and the central government spending is about 3.7%, or say 3.5%, 3.4%, how much more can it actually contribute? So this is effectively less than 10% of overall investment to GDP in the country. Investment activity in the country is going to be a lot more dependent on how well the real estate cycle turns, how well the power generation cycle turns. And I think this almost obsession with waiting for the government to spend an extra 40,000 crores, in the larger scheme of things, these are all rounding errors. Remember that the fiscal space for the government was very limited. In fact, in the preview session that we had in your studios, we had discussed this, that, all said and done, there is only about 1 lakh crores, which is less than 0.3% of GDP in FY26, is that the government has discretion on. I think it is unwise to expect the government to be doing everything. And I don't think it needs to be doing everything. If the real estate cycle turns, if the power generation cycle turns, and both seem to be turning, we will not be dependent on the government to drive up, say, the industrial stocks or the earnings for industrial companies.
Hi, Neelkant. Good morning and good to see you. And you're sounding pretty satisfied with regard to what the government has done on the capex spend front. But what about the approach to markets? How would you alter the approach to markets? Given the consumption push, they've maintained capex reasonably. But we also have this threat coming in from Trump's tariffs. So your take on the equity markets from here on, post the recent correction?
Absolutely. I was waiting for someone to say that. So the budget is now in history, right? Budget was largely as expected. There was a 1 lakh crore of tax cut for the middle class. But remember that the government is still shrinking its fiscal deficit. And therefore, the aggregate impact, or the demand on aggregate impact on aggregate demand, is actually still negative. The Trump tariffs, on the other hand, are going to be, they have triggered something which is very substantial. See, normal wars, especially if they are being fought in other jurisdictions, can actually be accretive to earnings, and sometimes they support stock markets. Here, there are political objectives being met through economic damage. So knowing fully well that this will hurt the US economy, and that if there is retaliatory action, it will hurt many parts of the economy. And on top of that, to potentially escalate it to Europe and other parts, I think all of this creates significant uncertainty for the economic forecast. And that, I think, is terrible for markets. So over and above what is happening with the DXY, over and above the 0.8 to 1.5% seems to be the first cut impact on US GDP because of the decisions announced. The reason why the markets are not reacting even stronger is that everyone expects that this is temporary and will be withdrawn. But this adds a very different layer of uncertainty to economic forecast.
All right. And I'm sorry, we'll be sort of jumping here and there, but allow me to jump back for 1 minute. So focus away from infra, that's wrong interpretation you said. But you would agree there is focus on consumption now, right? That you would agree with, Neelkant? And this is after some time putting more money in. And it's not just 1 lakh crore, it's not one time, right? It's recurring. And there is a broader, I don't know whether there's messaging or it's kind of, it had to be done. The move itself is one time, and whether we'll see more moves, etc. So from stock market point of view, consumption, where will this money go according to you? And is there anything investors can do based off this?
Yeah, so that is somewhat easier to quantify. So if you look at the number of people who disclosed income to taxpayers, see if you're earning that much but you're not paying tax anywhere, you're not impacted. So we have to look at the people who pay taxes. So that this eases our job. The biggest impact is for people disclosing earnings between 12 lakhs and 50 lakhs. The number of people affected, because the last data we have is for FY23, was about 58 lakhs. If you extrapolate it to say FY26, maybe about 75 lakh. That's the number of people who will be the biggest beneficiaries of these tax cuts. And most of these people would be in the 90-95 percentile, maybe even higher. The higher ones, maybe the percentage impact will be lower. What is their discretion? What is their incremental demand going to look like? And that's mostly going to be discretionary. So I think that the impact of this directly will be mostly on the discretionary items. So jewelry, retail, and somewhat, I think the market was responding rightly to this on Saturday, cars, two-wheelers, etc. So at an aggregate demand level, remember that the deficit is still shrinking. So, and a large part of the space that is being created for these tax cuts were actually also coming from personal income taxes. Absolutely. So whatever you are seeing in terms of better compliance, more people disclosing higher incomes, is now the government has decided to take some bit of that and give it to what was becoming the pillar. So if you compare India's central government's fiscal math, FY19 to FY26, over 7 years, the government has so far seen a very sharp increase in personal income tax to GDP. A large part of that has actually gone into increasing capex because primary deficits are more or less back to where they were in FY19. And so going forward, if you have another lakh crores and there is no ability to spend it directly on the issues that you can control, on the areas that you can control as a central government, then you might as well give it back to the taxpayer, which was actually funding a lot of this capex. So that seems to be the political economy equilibrium. I would expect direct impact on the segments which are affected by this, but overall, the questions on whether this increases inflation, whether this increases the current account, I don't think there will be any impact.
So, Neelkant, then the next question is that do you expect this to be a recurring and long-lasting kind of impact, which means that, it is the capex, it is the consumption side of the economy that suddenly gets turbocharged? Because I'm trying to understand from a portfolio shift point of view, what immediately happened on Saturdays, immediate herd mentality, right? Everybody is rushing to consumption, trying to sell out of capex. Now, do you see that only as a short-term market trade, market move, or do you think this will lead to structural shift in portfolio, especially for long-only funds, bigger institutional investors, where they need to now unload on capex a bit and go back to consumption, because you see that is as a medium-term 2-3 year cycle, perhaps?
Look, 1 lakh crore, which is less than 0.3% of GDP, being shifted to tax cut should not drive a change in portfolios. I think that we have to keep in mind that, one, the impact of this can potentially be higher. So some amount of this will be saved. Remember that this is the segment which also provides a lot of financial saving. But the likelihood of, say, buying a car on EMIs, using this to buy an apartment, a bigger apartment, and therefore pushing up the real estate cycle, and that then driving another investment activity. So I think there are many ways in which this can be spent, and it would be quite myopic to actually limit it to just saying, oh, let's buy all consumption stocks. Frankly, there are other parts of the economy which are also likely to get affected. And I don't think this necessarily swings the government towards more profligacy, or this is a sign that the government is starting to become more profligate. I think what the government has signaled through the medium-term debt to GDP paths that it has disclosed, it shows that if the year is looking good, if tax to GDP is looking good, they may consolidate by 10-12 basis points going forward. If things are looking bad, they may even raise the deficit by 10 basis points. But they are continuing to focus on fiscal discipline and also acknowledging that there is a very limited space that they have. I think extrapolating this to mean that, the whole economy shapes up because of, 0.3% of GDP moving this way or that would be very unwise. So I would recommend that we remain focused on because this is going to be an investment-driven recovery. Okay. The way you drive growth going forward, the only way to do that is to accelerate credit growth. If credit growth has slowed from 17 to 11, somehow getting it back to 14, 15% by using all the monetary tools available, macroprudential tools available. Those will be the channels through which growth happens. And therefore, if I was thinking 6-12 months out, those would be the areas I would focus on.
That's fantastic nuance. Excellent points, Neelkant. Nigel?
Well, Neelkant, I'm in the mood to look ahead. So the budget we have discussed, it appears it's pretty satisfactory for you. Trump's tariffs could add an element of uncertainty, and for the time being, maybe the markets are ignoring that just for the time being, hoping that things don't get too bad. But let's talk about the RBI. That's the next big cue for the markets as well as for the economy. What are your expectations from the RBI? In this uncertain backdrop, you have the rupee that suddenly moved to around 87 odd. It's showing some kind of weakness. Your take, expectations from the RBI?
So, I think the RBI's job is unenviable. There is significant volatility in global financial markets, and I think that will only intensify because now that once you've fired a salvo, it will be very hard for the US to backtrack. And if their closest allies in the NATO or in NAFTA, basically Mexico and Canada, they also retaliate, and they're threatening to retaliate. It actually emboldens everyone else that the US goes after this to actually do the same. So I think that economic uncertainty has just gone up dramatically. The US dollar appreciating, because that's a classic response when there is de-risking. Everyone jumps back into the US dollar, makes it much harder for the central bank. But let's look at what they should be doing. I think it is very important to inject back the durable liquidity that they took out, or they were forced to take out because of the FX intervention. So if there is, give or take 5 trillion rupees, 5 lakh crores that was sucked out because they had to sell dollars, at least that amount of liquidity has to be injected in one form or the other. They've started strongly with about 1 lakh crores last Monday. I think more needs to be done. Second, there needs to be maybe some moral suasion, maybe some backing off on, say, the restrictions on the credit deposit ratio, maybe even changing the macroprudential risk weights to target credit towards areas which are relatively safer today, like real estate. So these are areas where that RBI can and perhaps is likely to act.
All right, Neelkant, lovely conversation, lots of perspective as always. Thank you very much for joining us here on CNBC TV18 and wishing you all the best of luck. Well, I think we've got the market rates coming up in just a couple of seconds from now. And we'll look at the indices and then we'll go into stocks. 160 lower on the Nifty in the pre-open, 23,300. So what do we have? First, rates are up, so about 190 lower on the Nifty on the index, and the sensex, of course, is lower. I think we'll just refresh this because we'll just have the rates come up. 200 points now lower on the Nifty is what we have. Okay, let me just quickly look at the large sort of indices and stocks, etc., and how they're starting. I mean, Hindalco, BEL, L&T, Tata Motors, BPCL, Coal India, these are the 2% kind of cuts which are coming at this stage. Maruti is up 3%, it's the top gainer, but there is Titan, Eicher, Nestle, etc., which are up as well. But very few stocks, about 5 names out of the 50 names are higher. And I think we should be able to put up the heat map now as well. So 200 lower on the Nifty to begin the day. Surabhi.
Well, the Indian market's showing a fair amount of resilience in the backdrop of the whole global sell-off. Talking about the Nifty, the losers right now include Hindalco, BEL, L&T. There is Tata Steel also slightly lower, Tata Motors, BPCL. So it's across the board really. Trends are hard to find. But yes, you can say some of the more global-facing names, for instance, metal stocks, they're coming under more pressure. And there is some continued selling in the capex names at this point in time. L&T, for instance, down about 1.5%. Maruti, Eicher, Titan, Nestle. This is exactly the commentary you've been hearing over the last 1 hour. The market expects, at least in the near term, discretionary capex companies and stocks to do better, and that's where the buyers are gravitating. Let's see how it plays out. ITC, Lever are absolutely at the flat line. Let's check some of the bigger banks. HDFC Bank down about 1.5%. Bank Nifty itself is down about 1.2%. ICICI Bank is also lower, about 1% lower, and SBI also 1% lower. So a little cautious, but let's see if we can kind of recover from the lows.
Well, the Nifty Bank is at a very, very crucial mark. It's moved to the 20 DMA, and as we speak, is just flirting with that 20 DMA. So that's the very, very important mark that we're talking about for the Nifty Bank. Keep an eye out on that. Stocks that are moving around. Oncology-focused hospital chain, Healthcare Global, that's up close to around 5%. So good up move is what we're seeing on that one. KPI Green, from the top, the stock had corrected close to around 50%. The last few sessions, it's been moving from circuit to circuit. Commissioning of units is what we've seen out there. So that stock, in fact, is up close to around 5% as we speak. On the flip side, you have Dreamfolks. That stock is open gap down. So keep an eye out on that one. Blue Star as well is down close to around 5%. Volumes as well fairly large for the first couple of minutes. Persistent Systems, that's another stock that's lower in today's trading session. So just keep an eye out on that one. And Zensar, I recall that stock, in fact, it went up big time on budget day. I think it was up 7-8%. And last week itself, it had a very, very good run. But Zensar today is giving up some part of the weight that it's put up. A few more stocks to note. RVNL, some of those railway-related plays, that stock is a little bit lower. IRFC as well is down close to around 3%. And I think the oil marketing companies, you had HPCL, IOC as well as BPCL, all of them pulling back a little bit in, quite a bit actually, in the pre-open. And that's what the rate starts at as well.
Absolutely, and 200 points lower on the Nifty is what we have. We are at 23,256, so lots of stock-specific moves. It's early, but declines to advances is 6:1. 6 down for 1 up. That's essentially the tally that we are looking at. Well, let's welcome in our market master of the day. Is one of the largest fund managers in equity side in India, S. Naren, Executive Director and Chief Investment Officer at ICICI Prudential AMC, is joining in. Naren, it's a great day to have you with us here on the program. Thank you very much. Great day, not for the market, but important day, let me rephrase. Naren, how are things set up according to you? The budget, what were the two big sharp points that you took away from it? There's this tariff bit. Expectation is it'll blow over. It's not permanent. And of course, there's monetary policy ahead. Where does all of this leave markets?
No, clearly it was a budget which was focused on consumption for the middle class, and they gave money to the middle class. Whether they'll choose to save it, repay loans, or consume, this is the question for which we don't have the answer. But having said that, that is what the budget is about. And of course, today it has been taken over by what has happened in US on Saturday night. So we have a situation where the budget is no longer the central piece at this point of time. It has been taken over by that. But that's where we are. But having said that, this was needed because over the last 3 to 4 years, we have had a situation where the infrastructure and capex side of the economy has done very well, but the consumption side of the economy had not done well. So, as contrarians, we have always believed that, you will always have these cycles, and therefore the consumption side of the economy had to do better, and the budget gave that shift. So it's a very positive budget from that point of view, and it is the right thing to do at this point of time.
Naren, we had Neelkant earlier, who you know well. And I asked him whether the messaging from the government is shifting away, taking the pedal off infrastructure spending, because maybe that's not, the government can only do that much, the central government. Definitely it is focusing on consumption. As a money manager, Naren, what does it mean for portfolios, you think? You think there will be a difficult shift away out of these infra kind of names to consumption names? You've complained about the very high valuations, infra, capex, etc. kind of stocks have traded at.
Yeah, actually, for us, it was very logical that, for example, there was a time when we used to complain about very high valuations, consumer stocks. And for a change, we do have consumer stocks in our value fund, for example. So I would say that, this kind of shift was very logical on the part of the government. And so we don't complain. And I don't think it's a total shift away. It is just that you have to always, I think both the government and the regulators have to keep on doing things to help the areas which are not doing well, and actually to not give further support to the areas which are doing too well. I think that is the role of the government and the regulator, and that's what they've been doing. Last year, for example, the regulator actually slowed down personal loans. That was again a very good step. So I believe these kind of steps have to be done on a continuing basis. And as fund managers of public money, we also have to be very cautious in sectors where things are very costly. So we have been cautious on small and mid cap. And we have been more positive on sectors which we used to be very negative on, like consumer staples, etc. So I think that's the way things should be, and that's the way I think long-term money is made actually.
So, Naren, hi, great to have you with us this morning. So this is exactly what we were sort of discussing with Neelkant as well. The question is now, what is the change in the portfolio? And I'm not talking about short, tactical trades here and there. I'm talking about someone who's looking at least a 1-year portfolio, 2-year portfolio. Would you recommend that that person cuts down on capex a little bit and loads up on consumption, discretionary consumption? Or no, because you yourself are saying that it's not like the government is taking the focus totally away from capex. From a portfolio stance, 1 to 2 year view, what is the kind of directional change that you would recommend, if any?
See, I think from a portfolio stance, what we've been saying is it is actually small and mid cap, which is really very costly. And that is the area where over the last 1 year, we've been advocating people that they have to be cautious. So we closed our small and mid cap for lump sum investment as a result. And that is the area where I would say that even today, after the correction, valuations are still much higher than large caps. So that is the area where we would be even more careful. And I would say across various sectors, small and mid caps have got overvalued. And that is a bigger problem in the market than even large caps across. If you look at large caps, I would say there aren't too many large caps in the infra capital goods space itself, so that for us to actually really think about. And that is where we are being careful. And still, I would say you have to be careful in small and mid caps in various capital goods space or infra space. In all these spaces, you have to still be careful wherever the valuation has gone up too much. But I would say you have to be careful in capital good in small and mid caps across sectors.
All right. Hi, Naren. Good morning and good to see you in. And you've been making this point, right? Cautious on the broader markets in comparison to the large cap names. Naren, earlier this morning, we were highlighting a few of those stocks, like the chemical stocks, some of those molecules in the US, that they export out there, that could get a bit of a booster shot because if these tariffs are imposed on China. In that backdrop, I wanted to ask you, what is your contra play you're looking at? Is it chemicals? Is it metals? There's a lot of uncertainty out there. Or is it cement? Some of these sectors haven't done well. So that's why I'm just pointing out a few. But what would be the big contra theme that you're looking at?
See, clearly our contra theme over the last 1 year has been asset allocation because people are just not willing to invest in debt. Clearly, chemicals was one such contra theme also, but it is not a very large sector. But chemicals has done very badly in the last 3 to 4 years. So that it was a contra theme, if you ask me, but not a large sector from that point of view. But our contra theme has been asset allocation because no one was willing to invest in debt. And it was such a trouble to get people to think of even asset allocation and hybrid funds in a big way because people said, we'll invest in small cap, we'll invest in micro cap, we'll invest in SME IPO, but we will not invest in asset allocation. So our big contra theme actually was to choose people to invest in asset allocation. And today, as we speak, it's very heartening to note that today many of the hybrid funds that we run have delivered as well returns as many of the small cap and mid cap over the last 1 year, primarily because of the last 1 month. And that's been a happy feeling because most of the time we used to be questioned as to why you are recommending cautious stances all the time. And that has worked luckily in the last 1 month.
Naren, just to come back on consumption, where you've said that you've recently started taking a little more positive stance on the sector. I'm just trying to understand what kind of re-rating or multiple expansion can we expect? Because the other argument is that, you know, how much do you want to pay for, say, 4-5% volume growth? I'm talking about consumer staples. So do you see those multiples going back to the heydays of, you know, 60 times, 70 times? And again, if I talk about the other end of consumption, where growth is visible, now, whether it's Trent or Zomato, these new age consumer stocks, discretionary consumption, jewelry companies, hotels, what is a reasonable level of, PE expansion that you would be comfortable with?
This is a complicated question, and this is what we keep debating. Frankly, yet we are not yet in a situation where it's possible for you to actually bet that things will zoom up from here in consumption side. I think because the sectors have got re-rated already in 2-3 days significantly. So, you know, we have to do a fair amount of bottom-up thinking. And I don't think we are in a situation where you can get big returns from the market at this point of time, which is why our recommendation has still been asset allocation over everything, large caps over mid cap and small cap. Clearly avoid SME kind of areas, avoid unlisted kind of areas. This is what we're saying. We're not in a phase where you can make mega returns. That doesn't mean that these stocks are going to fall from here. I don't think that is also true at this point.
Right. What about Naren? Asset allocation has been such a big talking point for you over the last year and a half, maybe 2 years. Gold has done so phenomenally well, Naren.
Yeah,
it's just amazing. Almost $3,000. What's your view from here, Naren?
it's impossible to convey to tell people at this point of time when you're doing asset allocation, invest in gold on just like that, because gold is a phenomenal asset when you see the geopolitical problems at this point of time. That is why multi-asset is the only way in which we can think of gold now, because there's just too much of problems on the geopolitical side. Each country wants to levy duties on other countries. So at that point of time, some investment in gold is okay from an asset allocation standpoint. But would we like to recommend standalone investing in gold and silver at this point of time? I don't think so. I think that phase is over. That phase of being very positive on gold and silver standalone is over for us in our framework.
Okay, but relative and part of the portfolio basically, right?
Yes,
that continues.
exactly.
Naren, I think about a year ago you said for the next 5 years, actually maybe it was 2000, late 22, you said we are entering a period of macro markets for the next 5 years, maybe even longer. Do you still believe that, Naren?
Actually, you see the Saturday night's event, that itself shows that we are in a macro market, and in a macro market, asset allocation works. And that has been our central thesis under which we have been working. And I think we are in a macro market. And it is only good thing is that India's macro is in good position. So we are less volatile than the world because our macro is in good position. That is all that we can say. Otherwise, I would say that we are in a macro market. And if your country's macro is in bad shape, then the volatility will be very high. If India's macro is in good shape, so the volatility is lower in all the asset classes. That's all. That's how I look at it.
At a broad level, Naren, what about global-facing companies? Those are what's the view? We've spoken about consumption, infra, etc., all sort of local-facing. What about the ITs and the pharma and metal mining? Those what's the view there?
See, obviously, IT is a more defensive. IT and pharma are more defensive global-facing companies. They are therefore slightly less volatile. Global facing not so defensive sectors like metals, they're going to be very volatile. But if you see over the last decade, they have not done that well. So they've actually got derated over the last decades. You can't say you will never look at them because they have, as it is, derated over the last decade. So if you're prepared for volatility, they'll be more volatile than the market. But is it bad to consider them for some small investment? May not be. You can consider small investment, but at the same time, they'll be more volatile. IT and pharma will be less volatile, but they are not as cheap as the global cyclical sectors.
All right, Naren, if you could spell it out for us, what should the asset allocation be as of now? I recall in Diwali time, I'd asked you what would your view be on fixed income, and you said it very, very candidly at that point of time. And at that point of time, you were in minority. You said maybe fixed income does better than small and mid caps, and that's the way it's played out. So at current reckoning, what would your asset allocation be? how much of it would be towards equities? And within equities, what would your top bet be?
See, compared to Diwali at this point of time, due to the savage selling done by FIs in large cap, we are clearly more positive on large cap than we have been in September, October, November. And I think the time has come for you to do systematic investing in large cap and systematic transfer plan in large cap, because there's been so much FIs selling in large cap. But small and mid cap, we are still very careful and cautious at this point of time. And gold and silver is no longer an asset class where you can put big money in at this point of time because they've done too well. We are not that positive on dollar. We are not that positive on US NASDAQ at this point of time because those two have done very, very well at this point of time. That is where we are in the asset allocation framework.
So, Naren, okay, let's just simplify this to wind up. I mean, if I have 100 additional rupees to invest today, what are you saying? How would you divide it? How much gold? How much equities? How much maybe cash or fixed income?
You can't put such numbers. You can't put such numbers so easily. But I would certainly say consider large cap, consider debt, consider anything else other than NASDAQ, small cap and mid cap. That is all.
Safety first. I think that's the takeaway from this discussion. And just as we wind up, Naren, I mean, on this whole tariff piece, this whole global situation, do you expect this to be a slightly more longer lasting risk? Because some of the experts this morning have been saying that this will probably blow over. This should be a temporary phenomenon. They'll get to the talking table and it should blow over.
I don't consider myself an expert. I didn't know it will come on Saturday night, for example. So I believe that it will come, it will go, it will come, it will go. I think we have to be prepared for volatility, and volatility is good provided you know how to handle it. And that is why we believe in asset allocation, which allows us to play volatility.
I got that. Naren, one sector, usually I don't ask sectors with you, but oil marketing companies, right? Look at HP, BP, IOC, the stocks will all come up. They're all down 6-7%. And the question many investors are asking is, I mean, looks like from what the numbers have been presented, they'll have to bear the LPG burden, the subsidy burden. Any thoughts? Have you looked at that? I mean, that risk is back.
Anything which falls off a cliff, and companies with good amount of assets and oil marketing companies like that, if you take a view that oil is not going to shoot up, I think those are all sectors which are not that bad after a big correction. That is how we look at things from a contrarian framework. So if a sector has fallen off a cliff and, these are all companies which can't be created in India any longer. So I believe that's why we wouldn't be so negative after a big fall, clearly at this point.
Okay, well, that's the framework, and always contrarian, one of the few true contrarians out there. Thank you very much, Naren. It's a pleasure having you with us here. Thank you for joining us here on the program. Well, markets have recovered, I must say. We're down about 160, which means about 50-odd points off the lowest point of the day. Nigel, that middle-class tax cut, will it go into spending on travel and hotels is the question. Right?
Well, even with the high taxes, people were still spending on hotels and travels and luxury. So now maybe more.
Indeed. Before we get to the discussion, I just want to point out the sector of the morning actually is chemicals. Because the markets are down, but just take a look at the chemical companies. Your PI Industries are at the high point of the day. UPL as well is high. I think Aarti Industries was down close to 5%, and that stock is on the verge of moving into the green. And this was a sector that we highlighted at the start of trade. It could be the sector of the day. And the top three factors were there are key molecules that are being exported into the United States. China was a bit of a threat, particularly like for a company like PI Industries on pyrosulfone, that particular molecule, where people are saying that, China is adding capacity. That could be a bit of a risk. Now, that seems to have taken a bit of a back seat. And if you compare the current valuations with the 5-year average, it is at a bit of a discount. So that's why you're seeing some of these stocks that are doing very, very well on very large volumes. UPL, PI Industries, Jubilant and Griva. I think we should pull some of them up for you on the screen. But let's get to talking about the hotel space. In an effort to boost tourism in the country, the finance minister in the budget, the budget speech announced that the government will develop the top 50 tourist sites in partnership with states and also extend the Mudra loans to homestays. To talk about this in detail with regard to these developments, we are joined by Mr. Puneet Chhatwal, the Managing Director and CEO at Indian Hotels. Hi, Puneet. Good morning. Always good to see you in. Well, the infra status has been given to around 50 new tourist hubs. Is it a start? How happy are you about this? And also, if you could tell us, do you know what these 50 places are? And do you have any properties out there?
So good morning, Nigel. Always good to be with all of you on Monday morning, especially. And just listening to Naren, firstly, I have to say we are not suffering from any Saturday night fever. It was quite positive in our hotels. And I would like to believe that this week we will also benefit from hotels and not just from chemicals on a Monday morning.
You're in a mood. Puneet, you're in a mood.
Puneet, Saturday Night
Happy,
Fever,
happy.
you know, the song is ringing in my ears. John Travolta, you know, doing that dance, and you seem to be in that sort of a mood.
See, that's what I was saying, that even without this 1 lakh crore rupees of extra consumption boost, Puneet's hotels and resorts and, you know, the convention centers, all of them were chock-a-block. But now, to get back to Nigel's questions, now more of it?
More of it. So now, of course, definitely more of it. See, we are going through a positive balance in terms of demand in, outpacing the supply. So that is driving growth in your like-for-like portfolio in the sector. And for companies like us, which are very strong, not like-for-like growth, we are witnessing a good increase on both the top line and the bottom line, and I don't see that changing. Now, over and above that, I would say some of the mention of tourism sector comes up in the budget, and which pleases me a lot. It's definitely a lot more that needs to be done. So let me start with the macroeconomic. The macroeconomic story is good because, as the previous speaker said, if your macros are on the good, then your disposable income, your discretionary spend will stay on the good side. There'll be less volatility. So I think keeping the deficit in check, kind of giving a stimulus to consumption, which means a lot on food and beverage, and especially on our portfolio at the lower end with the Ginger brand, and also incentivizing some of the growth in the new 50 destinations is very good for those who would want to, take benefit of loans and hire a moratorium period. However, when it comes to the direct recognition, besides the 50 new destinations, I think tourism and hospitality is a very strong beneficiary of the Udaan scheme. It is a big beneficiary of the skilling. It is a big beneficiary of the Mudra loan, especially on the homestay business, and also the ease of travel. Having said all these positives, the one negative is I would have preferred, or two negatives, that the infrastructure status was extended to entire India and not just to 50 destinations. It should not have been taken out at all way back in 2012, which is 12 years ago. Because it is very strongly linked to the Udaan scheme and other investments in the infrastructure. So hopefully we'll get there during the course of this year. And second is marketing India as a destination outside of India. We should have had a significant increase in budget, and that budget has been significantly reduced. So with the foreign tourist arrivals still behind the pre-COVID level, I think it would have sent a very good message, not just from a financial and foreign exchange earning point of view, but also the positioning of the non-economic value, the soft power of India across the globe.
So, okay, let's talk business now that we've understood the bigger backdrop. Puneet, given the demand, and that demand push has only gotten bigger, like you said, right? What is the increase that you think you can undertake in pricing, ARRs, even on the sort of the corporate demand side, conventions?
No, Surbhi, don't ask.
Shareholder question. Shareholders will say there's so much demand, will Puneet drive up prices? By how much?
See, it depends. Actually, first you all have to, align yourself. You want an increase or you don't want an increase?
No, we don't want. Actually, let me rephrase the question. When are you cutting prices?
I think that's what my whole point on infrastructure was. With the change in the landscape, with the addition of facilities like Bharat Mandapam, with the Yashobhumi, with the Geo, there is a lot of demand coming into the capital of India and the commercial capital of India. What we have today gets filled up very quickly and it's not going to change, and that is going to drive the prices only one way, and that is up. With the change in consumption with so much money coming back into people's pockets. I'm sure a lot of them would want to travel both within India, and unfortunately, some might even go outside of India. So I think rate stability and increase in rates is definitely in for the next few years to come, with limited addition in supply, but an increase in demand. And that is good for our sector.
Puneet, I'm a realist, and I know it's painful, and I think, Prashant was trying to wish it away, but I'm a realist. So therefore, I want to hear the truth up front. How much of a price increase over the next 2-3 quarters do you think you'll be able to push through with demand being so buoyant? 10%, 15%, less, more, some range? So we're prepared.
I think anything which is double digit is the right way forward, and that by saying that, I'm also being realist, which means 10, 12, 14%, definitely not 20 or 25%. Some destinations will benefit because there is nothing that exists out there. Like even now, as we speak, for Mahakumbh, for that shorter duration of time, you could have 25, 50, 100% increase or 500% for a few days of Coldplay. But that's only a few days in a year. So I think the average across India, definitely we are in for a double-digit growth for the next few years to come.
Now when they announce price increases and we ask them why, they say, Surbhi ne pucha tha, Surbhi ne manga tha price increase.
Abhi sach hai, sach ka samna to karna padta hai, like they say.
All right, Puneet, let me ask you this. You've seen this on social media, it's not new, right? All these posts complaining about, if you want to take a 5-star holiday in India, and if, say, a 5-star holiday overseas, right? Many Southeast Asian destinations, the cost is substantially lower. Don't you think that eventually will start to hurt demand? Just pricing, staying and sort of even going higher from here?
You see, Prashant, markets are, efficient in terms of the correction always takes place if you get totally out of control. I think if you look at the pricing point of view, a lot of other factors have to also balance out in terms of exchange rate for dollar versus rupee, in terms of GST that is levied. We still have a slab of 7,500 rupees plus at 18%. That 7,500 was fixed 7 years ago. So I think there's certain things which are beyond our circle of control. And there the fiscal policy helps. It's the airport taxes, it's the cost of travel, is all kinds of other things. I was talking to somebody very senior, and there are places where we have renewed our contracts. Let's say in Taj Mahal Hotel in Delhi, where we are paying 32.5% as revenue share in terms of lease to the government. So every 100 rupees, going back to, you gave an example of 100 rupees where it would be spent, 32.5 goes straight to our landlord, which is a part of the government organization. On top of that, you have GST collection. On top of that, you have income tax from so many employees who are working in the property. So I think taking just one dimension view of just the price is not the right measure, because, and also somehow we tend to only talk about this sector in pricing. I don't think anybody else talks about pricing in any other sector. This I've not understood. Since so many years,
No, I complain equally. Equal opinion. Look at these flights, right? But Bombay and the Kumbh, they're 40-45,000 rupee flights, right? A family of 4-5 will spend 2-3 lakh rupees on flight. People are going, so I think there's just generally, it's not just hotels. The airfares also, I think, at least in some sectors, etc., have gone up, but take your point that it is, of course, markets at the end of the day. More supply needs to come, and hopefully with government support in terms of building out some of these destinations, the private sector will also invest, because, if the basic infrastructure is there, hotels will, tourists will come. You build, they'll come. I think take that point. Nigel, you want to come in?
No, I just want to ask, something with regard to this infra status that's given. Puneet, could you tell us how will this infra status help in lowering the cost of funds? Give us a brief idea. What is it and how much lower could it get?
Your basically cost of funds, you're able to borrow marginally cheaper up to 100 basis points, and your payment period or repayment period of the loan is extended. So basically that's what it is. And that puts you at par with other sectors. See, way back, as I mentioned, in 2012, a demarcation was made, and projects north of 200 crores and convention centers north of 300 crores were excluded which I think is wrong, because when you're building such great infrastructure in major metros, you actually need more beds to come in and more hotels to come in. And this being a very capital and labor intensive sector, it would be more aligned with the government. And the same thing on, I know you asked for infra, but I would still like to add international marketing fund for marketing India in various destinations abroad is a positive step over the next 10, 20 years.
All right, Puneet, it's good going for your sector, and obviously, I mean, there is extreme buoyancy in demand as well, plus the government help coming through. So I guess it's all going in the right direction. Thank you very much for joining us in the conversation today. Great chat. We look forward to talking again very, very soon. By the way, thank you so much, Prashant. Did you hear what he said? The revenue that they're sharing with the government on the Taj Singh property in Delhi, that's gone up by 30%.
Right.
So to go back to your earlier concern about lesser collections with the government, GST that we're going to pay in the hotels will go up. The revenue collection, the airport hike, again, Delhi airport, the tariff increase, government is earning, it seems like. No problems there.
Absolutely. And, it's more expensive for you and me. Well, 240 points lower on the Nifty is what you have. So basically, there's another round of selling which has happened. There was a 50-60 point recovery. We were down 150. We're down about 240 points now. So almost at the day's low. We'll take a quick commercial break here. You'll hear from the top equity strategists in the country. Rhythm Desai of Morgan Stanley will join in to decode the macro and the micros from the budget. But it's not just the budget, right? There's tariffs and more stuff which has happened since. So all of that coming up.
Welcome back. We're continuing the coverage, decoding the impact of Budget 2025 and also looking at markets right now, which are dealing with the other issue, which is the whole tariff situation. Right now, the Nifty is down about 250 points, and we're not that bad off, and markets have kind of tried to hold this ground. Rhythm Desai is our next guest on the show, and of course, their latest note is out. Managing Director and Chief Equity Strategist, India at Morgan Stanley. Rhythm, great to have you on the show. There's so much to talk about: tariffs, budget, capex, consumption. But what really caught my eye in that note of yours, that contrary to large pockets of the market, where people are saying go to safety, go to large caps, you are still retaining your bias for small and mid caps, and you still see, scope in that side of things. So let's open with that, why you don't think that mid caps and small caps are flashing red.
Hi, thanks, Subi, and great to be on CNBC. So this has to be contextualized. And we have to bear in mind that the news from outside India is not so good. So keep that aside. We'll come back to that subject a little later in this conversation. But the news from India is going to get a whole lot better in the coming weeks. So we've gone through a mid-cycle soft patch, which has, I think, lasted for about 5 or 6 months. It was rather idiosyncratic, led by extreme weather in August, elections in the first quarter, lack of spending by the government, and a little bit of tightness on the monetary side. So all this has assimilated into a slowdown in growth, which hurts SMIDs the most. And of course, at the starting point, the SMID valuations were looking a little extreme, and that correction has happened. I think we are now getting into a phase where growth will surprise to the upside. The budget reaffirms that. I think this is a growth-oriented budget. In fact, the phrase I've used for this budget is that it's a magic budget, and I'll come to that in a moment. And my expectation is that the monetary policy will back this budget, and the monetary policy will also become growth-oriented. So as far as India is concerned and what we control, I think things are looking up. Of course, as I said at the outset, the caveat is what happens in the rest of the world, and we can come back to that conversation. So that's the reason why I think that after this steep correction, now SMIDs are looking better than they have been for almost 7 or 8 months.
Well, Rhythm, you've retained your bullish view, and you've been the outlier bull on India throughout the last, 4-5 months, where we have been going through this correction. Now you're saying things are looking up. You're expecting growth to pick up, but up for what side of the market? Consumer or capex? That's the current debate.
So, I mean, if we take it only in the context of the budget, this budget has actually given a fairly strong fillip to capex. So the total capex as a percentage of GDP from the central government is going up from 4.1% to 4.3%. The 4.1% was already an all-time high. So we're making a new high in the subsequent 12 months. And unlike the trailing few months, I think this 4.3 looks a bit more achievable. You must bear in mind that the government capex in nominal terms in the central government's budget has more than tripled in the last few years. And they did, I think, hit a bit of a capacity constraint. If I would simplify this, this is like if, you are given tons of money to spend and told no wasteful expenditure, but go and spend it. There's a limit to how much you can spend. And that capacity only builds over time. So we have kind of tripled our railway spending. We've significantly increased our road spending. And as I said, overall, capex is up more than 3 times. So I think that's where we hit a little bit of a wall in the past few months. And the government is overcoming this by opening up new sectors for capex. And 3 new sectors stand out in this budget. So one is water. The second is distribution, and the third is housing. So the capex is moving away from what we saw in the last 2-3 years in terms of subsectors to new sectors. So if I were to use one word, I would say it's a capex-oriented budget, but of course it also has a big consumption stimulus via income tax cuts. So it has achieved both, which is why I call it a magic budget, and also actually achieved fiscal consolidation slightly more than what the market was anticipating. So that requires a lot of work, which I think the finance minister has done. And the budget numbers look quite good, actually. So it's not like these look, a little outrageous and there are some, crazy assumptions. Absolutely not. If anything, I think they'll probably surprise to the upside. Again, caveated by what happens in the rest of the world.
Hi, morning, Prashant here. And good to see you back after a while. I think you've given us the headline. It's a magic budget. The piece on consumption really, Rhythm, how much will this help in your opinion? And what will see that lift and that help? Which subsectors within consumption, in your opinion?
That's a good question, Prashant. It's not as obvious as it seems. So let's contextualize this. This is about 10 million people, 1 crore people, who are getting this tax break to the extent of 1 lakh crores. And it's not necessary that they will take this tax break and buy soaps from it. Okay. So I think consumer staples is certainly not the place where we go to. Consumer discretionary, I think, is a much better bet. And even there, I think at the higher end of consumer discretionary is where I think you will probably see some of this tax saved being spent. Some of it can actually also come into the stock market. All of it will go to the banking sector. So this is how I would break it up. And that's, the dilemma always with tax cuts. It's hard to predict what people benefiting from a tax cut will do with that money. They could just simply deposit it in the bank, or they could go and buy shares, or they could use it to buy some high-end goods. And I think you'll get a mix of all of that. Now, the exact mix is very hard to predict, but it'll be a mix. And all this is actually auguring well for the economy. When you've hit sort of a spending capacity limit and you don't want to do wasteful expenditure, and again, we should highlight this point, and I'll come to this in a second. So just give me a second. When you don't want to do wasteful expenditure, this is the best next alternative you have, which is give it to the people to spend. And that's what the finance minister has done. So kudos to her for that. Now on wasteful expenditure, again, yesterday's newspapers had no mention about this. The subsidy spending of the government has gone back to pre-COVID levels. It's now back to 1% of GDP. And we had achieved a multi-year low in 2019 at 1% of GDP. So it's, I think, 1.07 if I remember correctly. So the wasteful expenditure is, it's almost you wring the neck of your spending options. It's like you're tightening your purse strings, and at the same time, you're getting the private sector to increase its participation in the economy. The way I characterize this is that the government, and I think this is common knowledge now, the government did the heavy lifting coming out of COVID because private sentiment was weak. It is now stepping away and reconsolidating the fisc, in a way preparing for the next crisis moment. Because when another crisis moment arrives, if it ever does, you need spending capacity in the government. So you need to be always prepared for it. And now the private sector takes over. This is incredible, actually, if you think it from a stock market perspective. Very few countries in the world have this flexibility which we have, which is we can take the foot off the pedal, consolidate our fisc, and create capacity to address any upheaval that can happen in the coming years. And that is why this budget is magic. I mean, just one of the reasons. I mean, there are plenty of reasons why it's magic, but this is one more reason why it's magic. And I'll come to a third reason a little later, which is the fine print of this budget.
And we'll just come to that in a bit. But and I think that's very beautifully put, sort of explained in that sense. Just to go back to what we began the conversation with, small and mid caps, right? Now, Rhythm, but what about valuations? Because if you look at Nifty, this is data as of Friday's close. We were doing, I don't have the numbers now, but we looked at the Nifty 1 year forward multiples are slightly below the long-term average. If you look at mid-cap multiples as relative to Nifty and small-cap relative to the Nifty, they're still, even after this 18-20% fall that we've seen, they're still very rich compared to historical averages. So how should one put this in context?
So see, Prashant, I hate to look at valuations in PE terms. If I were to make this really simplistic, PE is nothing but price expressed in form of earnings. Like you would say price in INR, price in dollars, price in earnings. It doesn't tell you anything about what the value of a stock is. Ultimately, the value of a stock is the future cash flows discounted at your expected rate of return. The future cash flows from a stock is dividends, which come out of earnings. So that is a very different thing compared to what PE is. And PE can be very misleading. So there are many moving parts to this and why Indian stocks trade at the valuations they do. So the first and foremost thing is terminal value. There are very few countries on the planet that have any terminal value. Take the case of China, where I think the terminal value is close to zero now, which is why stocks in China seem so cheap. They are not cheap because ultimately equities require long-term growth to drive their value up. And India is, again, one of the few countries where long-term growth seems to be quite good. The second is the rate at which you want to discount future cash flows, right? That has fallen in India. Why? Because India's economy has become more stable. One of the messages from this budget is that we're not tinkering with macro stability. And not tinkering with macro stability makes our returns or growth more predictable. And what more can be sweeter for equities than predictable growth? If I tell you that a company's earnings, come what may, will compound at 20% in the next 5 years, you will pay up for that stock. Because predictability is the best news for equity investors. And by pursuing the type of policies that this government has done for the past 11 years, it is actually making India's growth more predictable. And that is why equities trade where they trade. They're not going to become significantly cheaper. And trust me, when they do become significantly cheaper, you will not want to buy them. Because it will happen in this moment where somebody comes in and disturbs this macro stability.
Hi, Rhythm. Good morning and good to see you. When you're sounding very, very optimistic about prospects, and that's good to hear. And in the finance minister, with regard to the budget, the expectations, they are factoring in STT to be much higher as well. So maybe they are factoring in a buoyant stock market as well. Give and take everything, Rhythm. How do you change your portfolio from here on? What are your top ads? What have you all deleted as well? I'm looking at it. I think HAL is something that you'll have pulled out, while Titan, Jubilant, those are the ones that you're relatively more optimistic on. So give us a portfolio construct.
Sorry, so I won't go into single stocks, but from a sector perspective, I think you want to buy the banks, particularly the private sector banks. I think that's the easiest trade in the market right now. The stocks are trading relatively attractively, and I think the environment is going to get more constructive for banks. So that'll be the easy one. Then I think you want to buy some discretionary consumption. As I mentioned to Prashant, this budget is, I think, built for an uplift to discretionary consumption, especially high-end discretionary consumption. I would still continue to back industrials, though within that portfolio, you have to realize that there are some shifts that are happening with respect to the subsectors in which CapEx is taking place. So you may want to orient yourself to that. I think technology looks quite okay. We are getting into a period where spending cycles seem to be going up. Everything else, in my view, can be underweight in a relative portfolio. But this is one point that I will make, is that this market is transitioning from a macro one to a micro one. So since COVID, we've been driven by macro factors. And I think increasingly this is becoming a stock pickers market. So it's really not about the Nifty and where it heads. It's about individual stocks. And I think the dispersion of returns across stocks is likely higher in the next 12 months than it has been in the last 2 or 3 years.
Absolutely. So just reiterating for the benefit of our viewers, Rhythm, you're saying that private banks are an immediate trade. You also like consumer discretionary. I want to go back to the three new lines of CapEx that you outlined. You said water, housing, and you said distribution. I think you're talking about logistics over there.
No, electricity.
Oh, electricity. Okay. So then the same question, how would you place stocks along these lines? Because you're still, relatively not too negative on CapEx.
Yeah, so CapEx spending in nominal terms in the budget is up 17% to around 15.5 lakh crores. So that's growing faster than their normal GDP assumption, which is why CapEx share in GDP by the central government is rising. What they've done in the budget is they've transferred some of this spending power to the states. So the allocation of grants to the states for capital spending is up almost 1,30,000 crores on 3 lakhs, so nearly 40%. And that is that's the gist of this budget, that the states are now being incentivized to undertake CapEx. And you think about the macro context here. There has been a growing risk of greater revenue spending by states for subsidy programs or for distribution. You want to reorient that spending. So the government of India is using its resources to help the states reorient that spending to CapEx. Another reason why I call this a magic budget. I mean, there are so many reasons. We didn't even go into the fine print. Allow me to go there. So all these years, 35 years of doing budget, the fine print has always contained bad news. I've never seen a budget with fine print that had good news. This budget actually had some really good fine print. It has diluted permanent establishment rules. It has created safe harbor rules. If you think about Make in India, I think this is a budget that really powers Make in India. A lot of multinational companies will be looking at this fine print and saying, oh God, we can now come in, it looks safe.
Okay, and I think it needs a proper fine print discussion, but we're always on the clock. A large individual investor has messaged me and said, please ask Rhythm about when FIIs will return in the context of all the changes made in the GIFT Nifty. Quickly, if you can contextualize that.
GIFT City.
GIFT City, yes.
GIFT Nifty.
Yeah, sorry.
Every morning at 9:15, there's a $100 million bid that comes from domestic investors. To do a trade, somebody needs to sell. Either corporates sell through IPOs, and then they'll allow FPIs to buy, or the FPIs sell. So this is the technical point. Okay, the GIFT City changes, I think, are very encouraging, and it should assuage a lot of foreign portfolio investors with regards to taxation, and should encourage them to step in. And these are changes that market participants were pressing for, and the government has delivered. So I would be very optimistic, but I think you need a bit of supply of paper for foreign portfolio investors to turn. Mind you, this selling that we have seen over the past few weeks has little to do with India. It is largely an emerging market problem, and the emerging market asset class does look very vulnerable. We actually did not get to that at all. But what's happening over the weekend and what's likely to happen over the next few weeks is going to create volatility. So people have to be prepared for it. And India may outperform in this volatility, but the Nifty will struggle. If the world is not going up, it's impossible for the Nifty to do its own jig. It's a very large market now in a global context. So it cannot do its own thing if everything else is falling.
Absolutely. A longer fine print budget conversation soon, Rhythm. You're calling it the magic budget. Thank you very much for joining us here this morning. Lovely conversation. As always, lots of insights and perspective. Take a quick commercial break here. See you on the other side.
Welcome back. Let's straight away take the focus to the commodity markets now and see how they are reacting to the tariff wars that have been unleashed. Manisha, good morning.
Morning, and thank you for that. Well, I'm looking at copper, aluminum, zinc, and most of these metals are trading 1 to 3% on the lower side on the London Metal Exchange. Well, that's the major market that you watch out for in the global markets. We have seen US announce tariffs on Canada, Mexico, and China as well. Well, 25% on Canada and Mexico and 10% on China. Importantly, when you look at all of those numbers there, Mexico and Canada support, or rather export to US is around 75% of their total exports. But when you look at the US exports to both of these countries, that stands at around 16 to 18%. So we can see it's very lopsided in sense of numbers there. But I quickly want to come to individual metals here and talk about copper. And US is the net importer of copper, aluminum, and zinc. And that's the reason you are looking at very strong premium in case of the US markets for many of those metal prices there. When you look at the copper numbers at it itself, the US is importing 36% of its copper from Canada and Mexico. 36% actually is exactly the number that US actually imports in sense of copper. And when you look at the prices right now today in Asian markets, we are looking at 6% of a premium reigning in case of the US markets versus the London Metal Exchange. So you are looking at a lot of hoarding, buying coming in, and that tariff impact already showing into the prices there. Talk about aluminum, and US imports 82% of its refined aluminum, and much of that really comes in from Canada and Mexico to the tune of around 60%. So we are looking at aluminum prices also trading at a huge premium when it comes to the US markets there. Talk about zinc, and US imports nearly 67% of its zinc requirements also coming in from the Canada and Mexico markets there. Canada supplies 50% of its zinc to US, and we are looking at zinc prices in the US markets trading higher, but zinc prices on LME right now are trading at around 2-month lows. We've seen a 3% of decline come in for the zinc prices in the Asian markets right now. Steel is yet again an important commodity, and we do see steel imports represent 17% of total imports in sense of US there, and 40 to 50% of steel comes in from Canada and Mexico into US, and we're looking at perhaps tariffs coming in for this one as well. Importantly, the US president has said that he would have a conversation Monday morning with Mexico and Canada as well. Remember, these tariffs come into being from 4th of Feb, so we still have today in sense of negotiations and conversations, but the market's already taking cues from these tariffs, and we've seen big arbitrages coming in for US, LME, and the Chinese markets there.
All right, Manisha, thank you very much for that. Commodities in focus. Up next, my colleague Latha will be in a conversation on the budget implications. She'll have B. Prasanna of ICICI Bank and Kaushik Das of Deutsche Bank to take you through, of course, the latest, which is tariff announcements, implications for global markets, rates, currency, all of that coming up. Interesting conversation.